Back in 2007, the Dow Jones Industrial Average hit its all-time high, 14,164. Yesterday, it closed just 210 points behind that landmark level. Rebecca Jarvis is here to look at what's driving this market.
Good morning.
Good morning. What's driving it?
Well, there's a lot of things driving it. For one, the individual investor is back. The individual investor in the first 3 weeks of this year put $6.8 billion to work in mutual funds that invest in stocks. That's pretty significant because what we saw in the past was the individual investor pulling out of the market. When the market hit its all-time lows in March of 2009, a lot of investors walked away. Now, the problem becomes investors, the individual guy, the retirement savings, often put their money in at the top as opposed to the bottom of the market, so they lose everything on the downside and they don't make up as much on the upside.
Why do you think the 14,000 point is significant, that mark?
It's a psychological thing, Nora, and part of it is a lot of people remember the financial crisis and it stays with investors in such a significant way. Now, when we look to the future, people can see that their retirement savings have pretty much earned back what they lost throughout the financial crisis, but there's still a number of open-ended themes here. For one, the Federal Reserve has been helping to drive all of this. They've put money into the market through their own form of stimulus. That's created a floor under stocks. Consumer confidence is still a big question because while the consumer has faced a lot of things that have improved, the jobs market improving somewhat, the housing market improving pretty dramatically in the last year, they still are now paying higher taxes, and that has really eaten into consumer confidence this year. Also, corporate earnings. We've seen corporations do a lot better this year so far, and most of them are beating what we expected them to do, but that's still a big question mark on the horizon, and the second half of the year tends to be more difficult for them than the first.
So most people you know on Wall Street, when you ask them a question what 2013 looks like, believe this rally is sustainable or not?
Well, I think, Charlie, most people on Wall Street, it takes two sides to make a market, right? Somebody has to think it's going long, and somebody has to think that it's actually going to decline over time. It's interesting, though, when you ask Warren Buffett what he thinks, I was speaking with him a couple weeks ago, he said the time to be greedy, and this is what he's always said, the time to be greedy is when everyone else is fearful, the time to be fearful is when everyone else is greedy. And so right now, if you look at the market climbing, you might say, well, people are being a little bit greedy right now. So there are some who would say things might pull back a bit. But overall, if you're thinking as an individual investor, how do I use my money? Where do I allocate it best? Over time, this is the trick. Over time, you keep your money there and you just let it ride. You can't pull in and pull out willy-nilly with the market fluctuations because usually you miss out when you do that.
That's also right from Warren Buffett's playbook.
Exactly.
Yeah.
He'd like to hold stocks forever if he could. That's what he says. The best investment term is forever.
Bottom line, everyone's looking at their 401k and saying, thank goodness it's going back up.
It feels like it's returned to a little bit better place.
Yeah, Rebecca Jarvis, thank you.